Hey, everybody, welcome back to another episode. Today, I am going to discuss the short-term rental tax loophole. This is something, guys, that you are not going to want to miss. If you've thought about investing in short-term rentals, maybe you already are investing in short-term rentals. If you have a practice, a business, or you're a W-2 employee and you're wanting to reduce your taxes, listen up. This episode is for you. I was recently I did a podcast with Yona Weiss. He's a cost segregation study expert, and he told me about this very little known secret about the short-term rental bonus depreciation loophole that I had never known before. This is a huge, huge tax loophole, and I want to share it with you right now. Before I do, though, this is not meant to replace any advice from a CPA or cost segregation study expert. Please do not listen to anything I'm saying and go discuss with your CPA or cost segregation study expert all the merits of doing this before you make an investment. Do not rely on this advice alone. All right, so let's jump into it. So I was on this podcast and was blown away by this loophole that I did not know about. Now, to give you all some context, one of the big advantages of investing in real estate is you get this real estate professional status. Why does that matter? If you have this real estate professional status, it allows you to purchase real estate or invest in other people's real estate as a partner. And if that deal offers bonus depreciation, it means you can write that depreciation off against your income. And I'm going to give you an example of kind of what that looks like here. It only applies to people who have this real estate professional status, real estate agents, a lot of some contractors even qualify for this, investors who invest in real estate. But it's elusive to a lot of people like doctors or lawyers or HVAC guys, people who own their own business outside of real estate. But the loophole is if your spouse has this real estate professional status and you're married to them, you can use that depreciation to offset the income that you're making in your business. I mean, it is huge. For example, what I'm telling you right now is if you made $1 million in your business this year, you're probably going to pay about $400,000 in taxes after your take home, right? If you've netted $1 million, you're getting hit with a $400,000 tax bill. If you then go and invest in a multifamily deal that offers, let's say, depreciation, and for you in particular, let's say that you guys are the only investor in this deal, and you're getting 25% of the assets value in depreciation. 25% of $4 million, that's $1 million. So for this particular multifamily deal, you're getting $1 million of depreciation write-off in year one. What that means is you can take that $1 million offset and apply it to the $1 million that you made, and in the IRS's eyes, you made $0 and you saved $400,000. Yes, that's the beautiful thing about using depreciation is it allows you to invest in a real estate asset, and through magic wizardry accounting that cost segregation study experts use to generate the depreciation, you can use that depreciation and offset it and write your income down and literally not pay taxes. And I promise you, if you're making some serious bucks, even if you're, taking home, 100 to 200 a year and you're paying, 30, 40, 50, 60, 70, $80,000 a year in taxes, doing this every single year, making an additional $80,000, $90,000 a year for 10 years, it's a lot of money. It adds up, especially when you're investing all those additional funds. So let's get into the tax loophole here. For those who are not familiar with the real estate professional status, you have to have at least 750 hours per year in the real estate profession. And, again, I'm not going to explain kind of what that is. Go look at it. But, real estate agents, investors, there's even some contractors that apply for this and get it. But you get to take advantage of the depreciation. If you are married to one of these people, you also get the benefits from it if you're filing jointly. And that's where it really, really comes into play. Now, this can be a big problem for those that maybe have a W-2 job or a business, and maybe you're single, you're filing separately, and you want this real estate professional status, but you don't want to spend 750 hours per year getting it, there is a loophole in the short-term rental industry that I just discovered. So what Yona was telling me was that if you invest in short-term rentals, and a short-term rental is defined as any income you receive for a property that is rented for 7 days or less, then that qualifies for this loophole that I'm about to share with you. And the loophole is that if you have short-term rentals and you are self-managing these rentals, meaning you're not hiring out a property management company, you're self-managing them, you're hiring the right people to go and clean it, etc. But you're the one managing it. You only have to work 100 hours or less, or roughly 2 hours a week, and you get the real estate professional status, and you can write it off against the other income that you have in your other businesses or your other W-2 job. Just to give you an example, Yona had a guy who was he's like a respiratory doctor or something like that, and he was making a significant amount of money per year, and he was buying these short-term rental properties, and he did not know about this loophole at the time until he heard Yona on one of the podcasts that he was listening to. Once he heard this and contacted him, they were able to go in, do a cost segregation study on his short-term rental portfolio, and literally the depreciation that he got, the bonus depreciation, and we'll go into bonus depreciation in another episode. We did a full deep dive on the Yona Weiss episode. If you want to go and look up Yona Weiss, I did a full breakdown of what depreciation is. But he was able to take it and literally offset all the income he earned from his business that he owned. And so he went from paying a lot, multiple six figures in taxes per year, to zero in taxes for that particular year. He went from paying multiple six figures a year in taxes to paying $0 per year because of the depreciation. And the money that he saved in taxes, he was able to use as a down payment to go and buy more short-term rental properties. And he just kept building his business up until he completely retired from his business that he owned in his I can't remember if it was a W-2 job or whatever it was, but he was able to retire from it. So I thought this was really, really fascinating. So there's this rule. If you are looking to invest in short-term rentals, or you already own short-term rentals, you're spending about 100 hours per year self-managing your portfolio, you qualify for this benefit. So go out and get a cost segregation study done by an expert. I had Yona Weiss on the podcast. He's a great guy. I've had other guests on, but you're looking for a cost segregation study expert. This can literally save you hundreds of thousands of dollars, sometimes seven figures if your business is doing extremely well. So take the time to go and do that. Hope you guys got value from this episode. If you have a quick second, do us a favor, leave us a review, hit 5 stars on iTunes. It helps us get this message out to more great listeners like yourself. We'll see you next time.